You'll notice that I'm putting an additional hyperlink. This was not hyperlinked earlier, project tickers. This is now hyperlinked. It's linking to this file, which is here. Okay, we'll be talking about this. And so in this session, now this is our session number 5. So we have finished in session 4. We have finished this particular problem. Okay, this 6.1 has been completed. The second session. Make sure you understand this. It's not once you get the concept, it's not difficult to understand. It's a lot of detailed steps. Make sure you work it yourself. Create your own spreadsheet. Otherwise, you will not learn. Okay. This is 27th. Today we are going to start on options. Okay. So the options trading project. So we will just recap quickly. So today's topic is we are introducing you to the options trading project. Right. Okay. So this is our first topic, just to give you an introduction to that. So what we have already completed is this. Okay. So we spend a lot of time in the very important topics actually, which help you to solve what are the structured logic for solutions to all these decision problems. Okay, you've seen that. Try to follow. Everything is logical. Okay, with just a few assumptions, everything follows logically. And so you make sure you understand the logic. Even if you can't express it perfectly in English, that's fine. I'm not penalizing anyone for grammatical errors. You need to understand that you have understood the logic. Don't try to memorize stuff. Okay, so these things have been done. Okay, we have completely solved all these decision problems. Of course, this one is a big one, the buy-sell bias, because it leads you into, once you get into your, the calc file, if we open the calc file, the buy-sell bias decision problem is a very big one. In a sense, you will never be able to cover the material for this particular solution, because it involves all these, all the fundamentals and technicals. So this stuff, the buy-sell basically brings you here. You have all this stuff that is involved. We will be doing some of this in this particular course on options trading, where we talk about option pricing models. Yeah.
So we are today learning basically how to start the project now, but not doing it, but just learning how to do it regarding the option via option trading, etc.
Correct. I'm just introducing you to the option trading project that you will be doing.
Okay. Sir, I actually encountered an issue last night actually regarding the TWS thing, which was basically saying that login failed due to timing of auto updates. Please exit all application sessions. So, sir, I would, if it is, if you could clarify my doubt post class, that would be nice, like full on doubt clearing.
Yeah. No, I'll just do that. We can do it post class, but I think what it might have, auto update might have something to do with the system update, the software update. And what you can do is you can try logging in at some other time. You might have done it closer to the US end of the US trading day. Perhaps you could try it, maybe early. Try it once at a more normal time, like the opening of the market.
Okay, sir.
Try it once that way, and then we can also discuss it after the class. All right. So yeah, so we will give you. So what I was saying is that we have already covered all this. We have covered all the decision problems, but in a sense, this one, like the solution I gave you to 6.1, now that we have pretty much covered it. It's there's nothing more to it once you understand what it is. It's a matter of just following it. But this one is actually kind of a never-ending, open-ended problem. Okay, so because this one basically takes you to the question about FA versus TA, and there are none of these are perfect solutions. Okay, so this and this, you can keep on learning endlessly about all these, especially about FA, because it's very open-ended. It's subjective. It's not really, you're never going to find the right answer. So everything other than proper arbitrage-free valuation, okay, which you have in the case of FX forwards, pricing, etc. Everything else is kind of subjective, and it's really not a perfect solution. So even these option trading models are actually subjective. So this, in a sense, when I say to you that we have already covered all this, in some sense, this statement is not exactly accurate with respect to the DP4 buy-sell bias, because this leads you to the consideration of FA versus TA and the actual use of FA and TA, and these are never-ending journeys. Okay, you have to keep on learning how to become a better and better fundamental analyst. Okay, even Warren Buffett is making mistakes. A couple of years ago, he made a big mistake in terms of valuing the Kraft Heinz. I think he failed to value Kraft properly. So, and they eventually ended up with the $11 billion kind of a markdown because of overvaluation initially, and when they paid for the deal. So Warren Buffett also is making mistakes. So there is no perfect solution. Okay, so you will always make mistakes, and it's a never-ending journey of learning. So in that sense, I just wanted to give you that heads up that when it comes to buy sell, the DP4, and even on technicals, the same problems apply. Okay, you're never going to find a perfect solution, so you're always learning. So I just need to put that in your head that there isn't going to be a clear-cut, closed-ended solution that such as we found in the case of 6.1, which is very clear-cut as to where you have to exit with a profit. So that's the only caveat. Otherwise, we have finished our discussion of decision problems and how to solve them in a structured manner. So we are now moving on to this particular focus of this particular project, of this particular, we can keep it here. We are now moving on to the focus of this particular term, which is the option trading project, the project for this. We're going to use the same software. I will try to reset the account equity if I can. Otherwise, we will just work with the closing account equity from before. And it doesn't matter because we are just looking at the percentage return from start to finish. So the starting value is not really that important. It doesn't have to be the same for everyone, as long as it's reasonably high. So what we are going to do is this option trading project. So I've given you this ticker. You'll notice that there is a project ticker now here. Okay, project tickers. These are the tickers for the underlying instrument. You'll understand later what I mean by underlying. But this is what you should be setting up in your TWS. You can wipe out your old stuff, okay? And you have, these are the tickers that you're going to be following, okay? How did I get these tickers? I'll explain to you. Now here, unlike what we had before, you will notice there is no sectoral focus. There's no sectoral focus here. I have really divided them into ETFs and individual equities, okay? I hope everybody knows what ETFs are. Who is going to educate us on ETFs? Let's ask Piyush. Piyush, can you tell me what an ETF is? What happened? Piyush is sleeping. Okay, let's find out who else is sleeping.
No, sir, I don't know.
And who else can help us? Gaurav, can you help us? What is an ETF?
Sir, I just know that these are the index that you can trade as securities.
These are the what?
Index that you can trade as securities.
Okay, let's ask Krish has raised his hand.
Sir, Utsav here.
Yeah, okay, let's ask Krish first.
Sir, these are the exchange traded funds, like stock we exchange in the stock market.
Okay, okay, fine. Utsav, what's your answer?
Yes, sir, exchange traded funds.
Okay, but okay, fine. So your number, at least Utsav and Krish have got the name right. ETF stands for exchange traded funds. Okay, but the point you have to understand is, why do I have this kind of distinction? Okay, why do I have this distinction between individual equities and equity ETFs? Okay, so now these are, as you can see here, this is Apple, Bank of America. Okay, then you have Apple, Bank of America. So if anybody has a question, just interrupt me and ask the questions because I'm not always able to see who has raised his hand. Okay, so you can just ask your question by interrupting me. So this is Apple, Bank of America, Advanced Micro Devices, Microsoft, AT&T, Facebook, Disney, Tesla, General Electric, Netflix, Roku, Uber, and Micron Technology. Okay. So what is the difference between these things and these things? Okay, why do I have individual equities and equity ETFs? Remember, this is a classification, it's a taxonomy, okay, of tickers. And so if I have boys in one column, girls in another column, can we safely assume that girls are not boys and boys are not girls, right? That's why I have this categorization. So that means we can assume one thing, that if I put equity ETFs in a different column from individual equities, that means these are not individual equities, okay? This is the difference, it's an important difference. First you have to know the name. See, the name itself gives you a clue. Exchange traded fund. Okay, we're using the word fund. When we talk about the stock of Bank of America, stock of Microsoft, stock of AT&T, is that a fund? It's not really a fund because these are individual.
Sir, your voice is breaking.
Is it better now? Is it better now?
Yes.
Not breaking.
Still bad?
No, sir. It is clear now.
Okay,
It is
okay,
clear,
fine.
sir.
Maybe I just have to stay close to the PC because it's a built-in microphone. Okay, so all right. So what we are saying here is that the word ETF contains the word fund. Okay, so when you have fund, it means it's a collection of tickers. Okay, so you have to understand that. We can put this in the session notes. We don't have anywhere else to put this material easily. ETF is equal to exchange traded fund. Spelling mistake, we're going to include, we're going to just exchange traded fund. What does fund mean? Fund means, okay, so therefore, collection of greater than one individual. Let me just save myself the time and copy it from here. Okay, collection obviously means more than one. Collection of greater than one individual equity security. Okay. So individual equity is stock of Microsoft, stock of Apple, stock of Micron Technology. These are individual equity securities. But if you have a fund, automatically that applies. Usually in a fund, you will not have just one security. You will have many many stocks in a particular fund. So the point about the exchange traded fund is that it's a collection of greater than one. Notice I've given the definition greater than one because technically even two stocks is a fund. Okay, but one stock we don't refer to as a fund because one stock can be put into this category. We don't refer to one stock as a fund because it can be put in here. Okay, let me just move this stuff here. It'll be a little bit easier. Yeah. All right, so we say we're a collection of greater than one because this is the definition, because even two stocks is a fund, but one stock is not a fund. Why is one stock not a fund? One stock is not a fund because one stock can be put into this column. So these are basically baskets of stocks. Now I've told you before, SPY is the basket of stocks that mimics the performance of the S&P 500. If you look at, if you can do a check, you'll see it's around 1/10 of the S&P 500 index. If you check the S&P 500 index, you will see that, and if you check the SPY performance, all right, here you see SPY, you will see that the S&P 500 index will be, I think, around 3,400. You can check that yourself. But this is the fund that mimics the performance of the S&P 500 index, all right? So you can go, and one of the things you can do when you do a check on ETFs is these are all collections of stocks. So if you see here, if you go to Yahoo Finance, and if you do a search on one of the tickers, one of the things you can see is the component stocks.
They're like a mutual fund.
You're right, it is like a mutual fund, but we usually, when we say mutual fund, what we mean is a actively managed fund. Okay, in the sense that Shaurya Sen is sitting there as the fund manager, and he's deciding that, okay, you know, I'm not going to buy Maruti. I don't think this is going to do too well. I'm going to buy Toyota, or I'm going to buy Daimler-Benz, Daimler Chrysler. So you're taking specific decisions to leave out certain stocks and put in certain stocks based on your preferences, your analysis. Whereas in it is like a mutual fund in the sense that it is a collection of stocks. Both a mutual fund is also a collection of stocks, and ETF is also a collection of stocks. But in the case of a mutual fund, usually what we mean by mutual fund is that it is actively managed by a fund manager. And therefore, when you look at two mutual funds, the composition could be quite different, even though they're same, both are similarly focused, both maybe growth funds. But when you look at the component stocks in the funds, they can be very different because they reflect the preferences of the individual managers. Okay. So whereas in the case of an ETF, there's something, see, when you put in SPY, you see S&P says Spider is just a brand name. Okay. This is like, you know, Quality Walls or something like that. So it's just a brand name. And S&P 500 ETF Trust. Okay, these are all set up as trusts. And you can look at this. I was going to take you to the holdings part of it. If you go, you can do this exercise for all your ETFs. And I think somewhere, if you look at the summary, yeah, if you see here, I don't know if the font is big enough. Let's make it 100. You can see there's an option for checking holdings here. Okay. If you check the holdings, you will not see this holdings option when you're checking on a particular if you put Microsoft, you will not see an option for holdings. Okay, if you put Apple, Alibaba, you will not see an option for holdings because those are individual stocks. There's no question of them having holdings. But if you go for any ETF ticker, you will see there's an option of holdings. Now look at this here. They haven't given you the top 10. Yeah, you see this? This is the ETF, S&P SPY. Okay, it's like an exchange traded fund. It's an exchange traded fund. They have given you the sector breakdown. That this fund has 11% in consumer cyclical, financial services 13%, and so on. These are sector breakdown, and then you can see the top 10 holdings. Okay, comprising about 28% of the fund. You see this? When you want to see this ETF, well, this is a fund. ETF means exchange traded fund, which means it's a fund. And a fund means it's a collection of more than one equity security, individual equity security. So my question is, what does this SPY contain in its holdings? Okay, I'm buying a fund. When I buy SPY or I sell SPY, I'm buying and selling a fund, not a particular stock. So I'm buying and selling a collection of stocks. Okay. So what is in that collection? Here you can see it here. This will obviously change from time to time, but today's composition you can see Apple 6%, 7%.
The time to time, is there any specific time limit, or like a week or a day? A specific time limit, or it can happen overnight?
No. See, you have to remember one thing. It is basically the S&P 500 index is a value weighted, is a market cap weighted index. Okay. So what is the goal of the fund? So when you're looking at any fund, okay, you can look at this fund overview here, fund summary. Okay. You see, what does it say here? I don't know if this is big enough for you to read.
Yes, sir. The investment seeks to provide investment results that before expenses correspond generally to the price and yield performance of S&P 500A index. The trust seeks to achieve its investment objective by holding a portfolio of the common stocks that are included in the index, with the weight of each stock in the portfolio substantially corresponding to the weight of such stock in the index.
Okay, so that is their goal. So in terms of what they actually hold here, this is just a means to achieve that goal. They have to always keep the goal in mind. Okay, and so therefore the goal is to always mimic the S&P 500 index. and the index will also change in composition in terms of the relative weights of the stock. So these guys, they don't rebalance every day actually, unless there's a dramatic movement. But the main thing is that they will rebalance in such a way so that they reflect the performance of the index. That's the goal. Because the people who are buying SPY, they want to get the same return as the person holding all the 500 stocks in the S&P 500 index. Okay, so these guys want to mimic the index. So this is basically the idea here. Okay, that any ETF, you will have many ETFs in your project. You have about 7 ETFs, but any ETF will have the same characteristic in the sense that here I was trying to show you more the fact that this is a fund, which means it has component stocks. Okay, it has more. It's not like a one stock. You're holding one company stock, Apple, or one company, Facebook, or one company, Amazon. No, this is a bunch of companies. It's a fund, so it's usually a bunch of companies, and you can see the composition of the fund. And as far as what Shaurya's question is, how often do they rebalance? Well, there's no fixed rule for that. The main rule is that the guiding rule is this: that we have to mimic the performance of what we have committed to. Okay. In this case, they have committed to the S&P 500 index. They want to replicate the performance of this index. So they will, therefore, all their rebalancing is going to be driven by the need to replicate the performance of the S&P 500. Okay. But the main thing yeah.
So more like an algorithm that has been set, and it's mimicking S&P 500. Whatever S&P 500 is doing, it is similarly mimicking via some algorithm, computer algorithm.
Correct. Yeah, that's what it is. Okay. So this is the main thing. So the main thing I wanted to show you here was that for any ETF ticker, you can go to the summary page. When you go to the summary page, you'll have an option for holdings. If you click that, you can see the holdings of that particular ETF. Okay, and percentage breakdown by percentage of assets. Okay, what are the stocks in that? So the main idea that I wanted to convey here is that any ETF is a collection of individual equities, and usually more than one. Okay, but even two is technically a fund. Okay, it's no longer one individual equity. So just one point I wanted to make sure that we understand the basics here. So that's what it is.
What
so
is the major difference between mutual fund and ETF? Major
the
difference.
difference is that, okay, let's put this on also, that
Sir, basically, the difference will be mutual fund can't be traded on daily basis.
well, that's also not true actually. Mutual funds are actually traded, you can trade them in terms of at least the end of the day, you can actually close out the exit from the fund. No, that's not the real difference. The real difference is that
Sir, ETF can be traded on day, on a single day, and mutual fund can trade for a longer time.
no, nothing like that. There is there are mutual funds that can be actively traded also, but usually mutual funds are traded at the end of the day. But that's not the real difference. S&P, these ETFs can be traded like individual equities. You can trade them. You can do 50 million trades in one day also in the S&P 500 SPY. There's no problem. But the real difference is not. That's not how you should understand it. Okay. What a very good question actually. That Shaurya's question, asked took us into this discussion, and I think Chris asked this question again. MFs are, and I gave you the partial answer, actively managed. Okay, and ETF by definition is passive. So we can write this in separate, maybe this font is too big. Okay, so first is, what is the definition of ETF? Collection, we make sure we get all the basics right. It's very basic stuff actually that we're learning, but we have to make sure we have our basics correct. So mutual funds versus ETFs, okay? This should be a plural here. Okay, what is this? Mutual funds are actively managed. okay? And they are usually discretionary in the sense that discretionary means in the sense that they are subjectively managed, in the sense the manufacturer, the fund manager, and the opposite of discretionary is systematic. This is a term that we use. Discretionary is subjective in the sense that there's some kind of heavy element of subjectivity in choosing, in deciding that, you know, I'm not going to buy Maruti. I don't like their prospects. I'm going to buy Toyota Motors, or I'm not going to buy ExxonMobil. I'm going to, in fact, instead, I'm going to buy British Petroleum. So these are subjective, very largely subjective decisions, although they are based on some fundamental analysis. But so the other term that we use is this is called discretionary, okay? And the other type of approach, the opposite of, I'm just teaching you the word here so that you're aware of it. The other word is systematic. The opposite of discretionary is systematic. And so these are all terms. These are all terms of art, as we say, which actively managed, okay? Actively managed, as I said, the fund manager decides, okay, that I'm going to buy this stock, I'm going to leave out this stock. And ETFs are actually more passive replication. So here you can see clearly that as Shaurya was reading out the mandate of the S&P 500, if this is your mandate, you can't, of the SPY, okay, this is the fund mandate. Remember, this is like the investor mandate. This is an example of an indirect investor mandate. So whoever sponsored this ETF, SPY, this guy, he actually assumed that there would be certain investors who want a passive replication of the S&P 500 index. So he created this fund by saying that, okay, guys, I'm going to be mimicking the S&P 500 index. So this is an example of the indirect investor mandate, where the fund manager decides that a particular type of focus for the fund will appeal to a certain section of investors, okay? Just like Steve Jobs decided to put the keyboard, do away with the BlackBerry physical keyboard and put the keyboard on the screen. Okay, nobody told him to do it. He just decided that this is something that consumers are going to like, having more screen space and making it a screen-based keyboard. So this is the same kind of thinking that goes in here, that you design a fund by assuming that a certain type of focus, here this is the focus of the fund, okay? This certain type of focus for the fund is going to appeal to a very large customer base. And that's why I'm going to design this product and I'm going to put it out into the market. And as you can see, that's a lot of people have invested in this market, in this stock. You can see the total assets of this fund. If you look at, this is set to, okay, that's in the summary actually. You'll see the total assets is quite big. Net assets here. You can see 295 billion. So 295 billion has been invested in this particular ETF. Okay. So the strategy definitely worked out for these guys. All right. So the point I was trying to illustrate here, so coming back to the question of the distinction between the two, that MFs are actually actively managed, okay, usually in a discretionary manner. This is what you're familiar with. Like if you look at the composition of the HDFC mutual fund, or you look at the ICICI Prudential Mutual Fund, they may have the same kind of sector focus, maybe healthcare fund for both the companies, for both the funds, but the component stocks could be very different because the fund managers have different views, all right? But when you look at ETFs, they are passive replication of some index, okay, or asset. Let's use a more general term, index or asset. So therefore, they will not have sort of this. What I will do here, this reminds me, I'm going to change one of the tickers. I'm going to change this. Instead of GLD, I'm going to make it GDX. This is actually a component stocks, and even SLB, I'm going to change. Okay, I'll do this change later. I'm going to make this. So don't add this SLV yet. Okay. I'll just put this as a, right. So this is one of your tickers because I just remembered that this GLD is actually trying to track gold futures. So I don't want that. I want the component elements in the ETF. I want them to be individual equities. Okay, so here, so you can see that this is what it is. So therefore, because the S&P 500, the SPY has a mechanical mandate, okay, it has a mechanical mandate, and it has to follow this, deliver this performance equal to the S&P 500. Therefore, it has. Can you see that? Can you see this from here? Can you get this idea? What I'm trying to show you here, the idea I'm trying to convey right now is this. The idea I'm trying to convey is this, that mutual funds are actively managed, but ETFs are passive, okay? Passive replication. So you understand the difference in active and passive. So passive, when you're managing an ETF, you don't have that much discretion. You have to passively replicate some index or asset, okay? It should be performance of all right. So this idea of passive replication, I hope you guys can understand this here when I show you this. See this? By holding price and yield correspond generally, therefore the results, investment results have to correspond to the price and yield performance of the S&P 500 index. How do you achieve this? By holding a portfolio of stocks that are included in the index, okay? With the weight of each stock being equally corresponding to the weight of the stock in the index, okay? So can you see the element of passivity that comes in from this? Once you make a commitment like this, you can no longer start saying that, you know, I don't like this particular stock. Yeah, I don't like this Apple. I don't think Apple has good prospects. Let me not hold Apple. You can't do that because if Apple is like 7% of the index, you have to hold Apple. Are you following what I'm saying? So the key difference between MFs and ETFs is that MFs, when we talk about MFs, usually they are actively managed. Historically, that has been the case. And even today, the large percentage of mutual funds are actively managed funds. So that you look at two different mutual funds in the same sector, like financial services, you'll see the component stocks in the two funds can be very different because the fund managers have different views. Whereas ETFs is passive replication, so there's much less room for active management. So this is the real difference between the two. Is this clear to everybody now? Okay, it's not so much how actively you can trade them or not, but this is the real difference. That mutual funds are actively managed and passive replication is what is required in an ETF, all right? So it is trying to replicate the performance of some index or asset. All right, so this is basically it. This is the difference. So now I was just trying to introduce you to the tickers. Yeah, so you leave out, I'll add one more ticker to this actually. In fact, I can do it right now and I will show you what I have done, it's also important for you to understand how to select a set of tickers for an options fund. If you're launching an options fund, we can no longer afford to have a sector. You still have a sector focus, but we are largely, because options volume is not that high, okay, for that many stocks. And we always want to be trading the liquid options. Whatever we are trading, futures, liquid futures, foreign exchange, liquid currencies, options, liquid options, everything liquid. Liquidity is a very important factor. So, because remember, it is connected to your slippage. If you trade in liquid markets, your slippage will be low. So your stop, when you have a stop, remember what we discussed here? We're talking about exit with loss and connected to position size. That every time you lose money, you should not lose more than your budgeted loss for a particular trade. And that budgeted loss, how do you stick to that rule? Don't lose more than the budgeted loss, is because you need to have, one of the things you need to have is low slippage or no slippage. And slippage is directly connected to liquidity. Okay, so that's why liquidity is very important. That's why I have, now what have I done here? Let's look at this. So I wanted to be guided mainly by option volume. So this is, you don't strictly need to know this, but I'm just teaching you, this is also an important element of your knowledge. For doing the project, you don't need to know because, yeah. So what have I done? I have chosen not 1 day's option volume, but average options volume. Okay. So here, 50-day average options volume. This is, I don't have a choice here. I could have taken a longer date, but I have to go with whatever these guys, but 50 days is good enough. 50 days is almost like 2.5 months, essentially. Okay. Average options volume. This is average daily volume. Okay. Over 50 days. So what I've done here is I have taken the tickers from here with certain exceptions, and I've applied these rules. You can also learn something from here. Now, SPY I've included. Why have I not included EEM? EEM includes, basically, this is a bunch of emerging market indices. So what I have done is I have left out stocks. I've left out ETFs and stocks that relate to companies and markets that are not trading in US time. Okay. Many of the components here don't trade in US time. Okay. China, Korea, India, all these things, these are not trading in US time. So since I'm trading in US markets, I want to include only the stuff that is related to the US markets and trading in US times, because the news that will come out of these stocks, this will come out in US time. Okay, so that's one rule. So this is eliminated. FXI is for China. I don't want to have anything to do with China here. Again, time zone problems. Okay. I have left out all these, which are actually trying to trade bond market indices. So I have always tried to include in your ETFs, only those ETFs where the components are individual equities. Okay. There's a reason for that. They generally tend to be more liquid, but also that the manner in which it behaves. I wanted to have the equity component inside the fund. So that I've left out these. This is included. This is included. This is included. Now I've left out this because what is this? EWZ is mimicking the, this is like the Nifty 50 for Brazil or the Sensex for Brazil. So EWZ is mimicking the performance of the Brazilian stock market. I have no interest in this, although it's kind of similar to US time zone, but I don't want to have anything to do with this. I left it out. Spider Gold shares, you saw me removing that. Actually, this is actually mimicking the performance of gold. So I think they're tracking gold futures. I don't want that. So I put in GDX. GDX is actually will have components which are gold mining companies. So I've included Alibaba. I left out because Alibaba's business is mainly in China. Okay, and a lot of Alibaba news will come out in Chinese time. I don't want to have that kind of stock in my portfolio. Okay, so I've left out stuff which is Chinese companies, Japanese companies, Disney, Tesla, General Electric, Netflix, Roku. Roku's customer base is largely in North America. Okay, they have some in Europe as well, but there's a lot of money coming from North America. So this is fine. This is what I put in, gold miners. These are gold mining companies. Okay, you will find if you go into GDX, I think you will find even Freeport-McMoRan might be a component stock there. Silver Trust, I'm going to leave this out, I think, because I think this is actually trying to monitor, trying to track silver futures. I don't want that. I'm going to leave that out. And I will probably put in Intel. I think we can straight away do that. What is the last stock I have here? Micron Technology. So what I'm going to do is I'm actually going to leave out after Micron. I don't want to, okay, regional bank. Yeah, we already have a financials. We already have a financials, so I'm going to leave that out. I will put in Intel. What is the last one we have? We have Micron. Okay, I'm going to put in Intel here. So you have a complete list. So we have 14. I'm going to make this Intel. So we have 14 individual equities, and I'm going to leave out this. Okay. Right. So you have 6. So I want a total of 20 tickers. You have 6 ETFs and 14 individual equities. So you got to set them up. Okay. So you understand now a little bit. I just gave you a little bit of a flavor as to how I selected this, the tickers. There's a logic in there. And there's some learning for you in understanding that logic as well. All right. So we can close this now. So these are your tickers. So what you should do is remove your tickers from the previous project and go into your TWS Classic and put in these tickers. Because later on you will have to just, what you do is right click on the ticker. I'm not talking about TWS, okay? Not this, I'm just showing you here because I don't have TWS here. So I have given you the link to the TWS option trader. We can launch that. So this has been now put into your, there is a section in your notes called project. So this particular note that I launched from framework, it's in the project subfolder, okay? And so you can see here, if you launch this, they'll show you how to do it. You can do it from any ticker.
Option trader. This optimized win.
You can see it for yourself.
This short video will explain the layout and some of the features of TWS Option Trader. This optimized window gives you streaming option chain data, option statistics, and quick.
Okay, so we don't have to play this in the class. You can play it yourself. But essentially what you can do is, if you just in the TWS Classic, this is how I like to do it. This Classic has a very neat display of tickers. So you just right click on the ticker and you'll see one of the options is trading tools. And I think you're under trading tools, you'll find option trader. Okay. So if you launch the option trader, you will see that kind of display that he was showing you. And then as you go through the technical material, the theory of option trading, you will understand better. But at least first set up these tickers. And once again, you will have to start forming views on these tickers because there is another element to option trading, which is implied balls, which you will be learning about. Okay. So if you see here, where are the eyeball charts? Okay, so this eyeball chart, you'll have to form a view on the eyeballs. We'll discuss all that. We'll come to eyeballs. But what I want to get you into the habit of doing, this is the 1 year eyeball chart. Okay. And this is the orange line is the implied balls. You'll have to form a view on this. We'll explain that. But you will also have to form a view on the individual tickers. Now I put in Intel for you. So you better start now following Intel, okay? Following Intel, forming a view on the stock. It's now launching. It's always launching I don't know if it's got to keep on launching. I'm going to use something else. This PC is very slow. So Intel, you want to be doing this. Looking at the chart of Intel, because these tickers are different from what you had in the first term, in the previous term. So now get into the habit of forming views. You got these 20 markets to focus on. Now get into the habit every day, look at them, follow what's happening in the US markets, tune into Bloomberg through YouTube, follow the live commentary, what's happening in stocks, try to get into the market, get into the mind of the market, understand what's happening with these stocks. You got the election coming up. There's a lot of volatility. Okay, so try to form views on, say, for example, look at Intel, okay, and form a view on what's going to happen to Intel. Okay, what is the future direction of the stock? Is it going to go down? As you can see here, there's a very big head and shoulder kind of pattern forming. There's a rally here. This is your left shoulder. There are actually two shoulders here. Okay, there's one shoulder here. This is one shoulder. This is one shoulder. This is a very unusual type of formation. This is the head. This is down. This is the first shoulder on the right forming. There could be another such formation, and then it could go down. If you look at, let's look at a long-term pattern. Yeah, well, it doesn't. The long-term pattern is not that. Yeah, now you can see what is happening. Now it could happen. So this is actually this is the internet boom. And one of the things you can see is that the 2000 internet boom, the internet bubble, they call it the internet bubble. And so one thing that is very interesting about Intel is, despite the growth of technology at the sector itself, Intel is still below its all-time highs set in 2000. Very interesting, because if you look at other technology stocks like Microsoft, you'll see that they're far higher than the, another thing you could look at, a very interesting look at is Amazon. See the difference between Amazon and Intel. Where was Amazon in 2000? Here, okay? And this is where Amazon is today. And you see the difference in Intel. You see the huge.
But we can't compare Amazon in that case because Amazon just launched before the .com burst.
I know. I'm just giving an example of it. You can compare them in one sense in that they are both kind of in the technology sector. They're both very technology driven. I'm just giving you an example of two very well-known major companies, big differences. So I just wanted to show you that Intel is not doing too well because it's still below the 2000, top. So anyway, you have to start forming views on this. You have to look at each of your individual tickers and get into the habit, get ready for your project. Some of the learning I am going to give you as we go along, like eyeballs and all that. But some of the learning you can already start. And one main element of all these projects is getting familiar with the market and getting into the habit of forming views. Even if it's wrong, it doesn't matter. But try to work out a method by which you form views and make a forecast for yourself as to which way do you think Intel is going to go. Okay, so that's basically it. So if you zoom in here, you'll see. So this is basically the idea here. So start forming these views, set up the tickers, start forming views on these underlying markets. Okay, you notice I've used the word underlying. Okay, we'll look at that. We'll explain that. This is also a term of art. So these are the underlying assets, and then there are going to be options on these assets. So when you have options on Apple, those are the individual stock of Apple is called the underlying asset. Okay. So if you look at here, for instance, in this case, let's reduce it to 100. Okay. So if you have S&P, okay, and one of the alternatives given, I don't want to use the word options because we've got options here itself. In a sense, these are all options, but these are, let's call them tabs. So this is your underlying asset, okay? This is your SPY, okay? We'll explain these terms, but you'll see that for all these tickers, you'll see an option, one tab for options. You can launch that. And you can see this, this kind of view, okay? You can make this a straddle view. We'll explain what the straddle is. This is very close, actually. We don't want this. We want a slightly longer one. Let's look at let's look at December 31. It redoes the list. Okay. All right. So if you see here, these are calls and puts. Okay, on the underlying. Okay. So this is the underlying, and these are the various option prices. You can see the option prices. Maybe I went a bit too far away. Let's look at December 18. So anyway, so the point is that for any of the tickers, before launching TWS, if you don't want to open TWS right away, you can get a sense of the option prices, even from your Yahoo Finance display. Okay, just put in the ticker, you'll see a tab for options, and you can select the particular maturity that you're interested in. Get a straddle view. You can see calls and puts, and this is around 339. So you look at the price. The strike is too far away here. You have to go down to the approximately where the price is, where you'll see more activity. Okay, so you can see the prices of the options. Right, you can see this is where you see most of the activity is centered around where the price is right now, 339. Okay, sorry, I pressed it too many times. Anyway, it doesn't matter. We'll see why. I think it's moving around too much. It doesn't matter. So you can see it here. So start forming a view. This is one thing you have to do. You have to start forming a view, and then we will now start looking at we'll start now getting into the theory of options. Okay. So we don't need to open this right now. Right. So we'll get into the theory of options. We are starting this particular project here, particular note here. Okay. So I've given you a bunch of links. You can play around with those links. These are all reliable links. Here we can see, I've given you a couple of readings. I think what you guys have is the 10th edition, but anyway, I don't think there's a difference in the chapter namings. That's why I've gone by chapter, not page number. So whether it's 9th or 10th, okay, it's the same. The chapters will be the same. So you read chapter 1, basically that's the introduction, 1.5, subchapter 1.5. And then chapter 10 from the start up to the end of flex options, okay? This is not directly connected to today's session or tomorrow's session, but these are the introductory readings. You can do them from the textbook. You'll have an example. And then you have the notes here also, all right? But I would always tell everybody, please make sure you make your own notes. Create your own note and then start making your own notes. Focus on the chapters, the concepts that you're learning. Like today, you learned these concepts, okay? ETFs, what is an ETF? How is it different from a mutual fund? And what did you learn? So instead of just looking at this or memorizing this, you write it yourself, make a small note, even if it's in shorthand, then you'll have a much better idea. You will internalize that knowledge forever. This is the kind of question that they might ask you in an interview, in a job interview also, although I think it's kind of very basic stuff. Sometimes they ask that. So, so make sure you do all that. Okay, so we start from here, options and derivatives, the introduction to options and derivatives. So let's launch this. Now, you'll notice here that I've used a particular type of terminology. One of the distinctions I have made is underlying markets versus, let me use this, otherwise this cursor is coming in. Underlying markets versus derivatives markets, okay? Sometimes it's called derivative markets or sometimes it's called derivatives markets. So underlying versus derivatives, okay? So what does this mean? It only means this, that when you have, this is what I just showed you, that when you have the SPY, which is essentially, it trades like a stock, but it's not a stock. You can trade it multiple times in a day. In terms of how you trade it, it's just like a stock, but it's actually an ETF in the sense that when you look inside this, the holdings, it's a fund. It's actually the stock in a fund. And the fund contains many individual equities. So in that sense, it is different from buying a share of Bank of America or AMD or Microsoft, because these are individual companies, whereas these things, they contain within them several such individual companies, right? So, but they trade effectively in terms of trading, there is no difference. When you actually execute trades, you can trade them just like these individual stocks. But these are ETFs and these are individual equities. That's why this classification. So when you talk about this, remember, use this language, individual equities. That means individual companies, each are different companies. And ETFs contain many of these individual equities inside them. So underlying here is this, the SPY price. And when you click on the options tab, you get the options, okay? So these are these calls and puts, okay? And you can see the last price on a 165 put. Okay, there is still actually even here, you can see out of the money puts, 200 put, 200 strike put on the S&P 500 when the underlying is trading at 340. Okay, 340 is the underlying price and the 200 strike put is, there's 48 contracts. The last trade was $1.7. Okay, $1.7 is the last price. So this is basically what it is. So what we're saying here, at this point, we're learning only about underlying markets and derivative markets. So the derivative markets are here. This is the market for the 200 strike put on the SPY, and the last price in that market is $1.7. This is the derivative market because the put is an option, the option is a derivative. This is the derivative market, and for every derivative market, there has to be an underlying market. And what is that underlying market? That is the stock in this fund, SPY, okay? That is the price of 1 unit of this fund, which is 339. One share of this fund is 339. This is the underlying. Okay, so that's what we mean by underlying markets and derivatives markets. So we'll get to the definition of derivative. We'll understand this better. So you can see this. So this is what one of the distinctions that we use. And the other distinction, which is there in the note you see, you can read it. So sometimes we talk about a distinction between underlying markets and derivatives markets. And we also sometimes talk about cash markets and derivatives markets or derivative markets. So underlying is sometimes replaced with cash. We say cash markets. So if somebody shows you the price of the S&P 500, okay, say somebody is talking to you about the put. So he might say, you know what, the 200 put on the SPY, the 200 put on the SPY just traded at 1.7. So the other trader might respond saying, and where is the cash market? And so what he means by that question is that, okay, I understand that the 200 strike put on the SPY just traded at a price of 1.7, and he's asking, where is the cash market? That means he wants to know this price. Okay, so in this case, SPY is being referred to as the cash market. So this is why I say that finance, so this is the use of the term cash market. So when he says, where is the cash market? He wants to know this price. So the response to his question will be, the cash market is 339.48. Okay, 339.48. So now this is the point that you have to understand, that when we use, this is why I say that finance is not like a science, it's more like law than like physics, because everything is context based. Now when we say cash markets, this is not the same as the use of the word cash here. Cash, trading value cash. If somebody comes to you, you're sitting in the stand chart trading room and customer calls up, L&T calls up saying, I want to buy cash. I want to buy dollars value. I want to buy $20 million value cash. Now that's not the same use of the word cash as what we are using here. Okay. And the story I told you, the trader wants to know where is the cash market. That when L&T says, I want to buy $20 million value cash, what L&T is saying is, I want to buy $20 million against the rupees, and I want the transaction settlement date to be today. Remember, cash is T plus 0. So transactions done value cash are transactions where the settlement date and the transaction date are the same. I hope you guys understand these definitions. You should have already read up. Okay, settlement date, transaction dates. These are all in your notes. You should understand them. So please understand this difference in this, how the same word cash can have two different meanings depending on the context. You have to understand that. This is why I say finance is much more like law than like physics, because the same word cash has two different meanings depending on the concept. When I say, when L&T says I want to buy $20 million value cash, what they mean is I want the settlement date to be the same as the transaction date, which is today. I want the dollars to come into my account today itself. That's value cash. But when the trader says that, you know, if he's told that the put is trading at 1.7 and he says, okay, where is the cash market? He's referring to the underlying market price. The different meaning of the word cash. Okay, so understand this. So underlying markets, also called cash markets, when contrasted with derivative markets. Okay, so this is one interesting distinction that we have. Okay. And so the options, as you can see, are derivative markets in general, but we will see there's one exception. Okay. So options are generally derivative products. Okay. They will be derivative products even when the underlying is also an option. The option is at least a derivative product. Okay. So the option is always at least a derivative product. Now, that's why I said options are always derivative instruments. There's an exception. This should be written as, then there is an exception. Okay. Options are always only derivative instruments. What is the only exception? That in the compound option. Okay. For compound options, you can read my book, which is there in your finance reference. A compound option is nothing but an option on an option. Okay. You can read more details in my book, which is there in your finance reference folder. But this is basically the statement we make is options are always only derivative instruments. That's why you notice that in this framework, under derivatives, I have options. Okay, the options are not over here. Okay, although when you have a compound option, actually there is a derivative option and there is also an underlying option. Okay, we'll come to that. But this is what, first let's understand derivative. Let's get some basic lingo out of the way, okay? Let's write it properly. Let's call it 1, okay. All right. Options are always derivative instruments. So the point here to understand is what is a derivative instrument. This is an important definition. Okay. Options, an important definition. Okay. So their options are always going to be derivative instruments. Remember, there's one exception where, because I said only derivatives. Okay. There is an exception where there's an exception where options are not only derivatives, they can also be underlying instruments. That is in the case of compound options. Okay. So derivative instrument, what is a derivative instrument? A definition that I've given you here is you will not find this definition in other places. Usually in other places, the definition that is given is that the value is derived from the value of an underlying asset. I have added two important terms here. These two are actually slightly repetitive. You don't need both of them, but I've done it deliberately to drive home the point. If I just use the word principally, that would have been sufficient, but I've also used the word inter alia just to drive home the point. Okay, so the general definition of derivative instruments that you find is that the value of a derivative instrument is derived from the value of an underlying asset. Okay. Now, this definition is not strictly correct. You notice how particular I am about the use of words. That's why I changed the definition. I said options are always only derivative instruments, and that is when the exception makes sense. So if you make any statement, okay, if you don't qualify it, like here I'm qualifying that there is one exception. If you make any statement and there is no qualifier, then what that means is that statement is always true. So if you know of a situation when the statement is not true, when you make that statement, you must write, also you must explain or mention that there is one exception when the statement is not true. So be very particular about the use of words, okay? So that's why when people write this definition, you'll find in many textbooks, derivative instrument is one which is value is derived, okay? Let's put this way. We can just write its value is derived from the value of an underlying asset. Okay, this is an important term, but I'm not going to this one. I'm going to put it here. Okay, there I want to highlight only my additions. Okay, it says the value is derived, from an value of an underlying asset. Now let me see. And what am I doing? This is the general definition. A derivative instrument is one whose value is derived from the value of an underlying asset. And what am I doing? I am adding these two terms, inter alia. These are kind of repetitive. So what I'm saying is that statement is strictly not correct, because if I say its value is derived from the value of an underlying asset, that means its value is derived only from the value of an underlying asset. Okay, that is, one asset is driving the value. That's what the statement will mean. But that statement is not strictly correct. There are other elements that go into the valuation of a derivative product. That's why I'm changing the definition and saying that it is derived, the value is derived principally from the value of an underlying asset. Now notice the meaning, how the meaning changes. The moment I say it's principally, so if it's like, if I say that, okay, this project was done by Sambhavna. Now what does that mean? That only Sambhavna did this project. Gagan did not contribute, Ketan did not contribute, Rajat did not contribute. Now that's a different kind of statement. But if I say that this project was done principally by Sambhavna, that means she did most of the work on the project, but that means that if I make this kind of statement, principally by Sambhavna, then I can later on add statements, but Ketan also contributed, Rajat got the binding done, or Gagan did the calculations in the appendix. So you understand the difference in the statement. But if I make the first type of statement that this project was done by Sambhavna, that means after that I can't make any of the other statements, because that means it was done by her alone. So that's what I'm trying to convey here, that this is the meaning of the statement. And why am I saying this? So the general definition that you hear is not strictly correct, because definitions have to be absolutely strictly correct. They must always be true, unless you have put in a qualifier like this one here. So let me show you why I say that this is not correct. Let me understand it. So when you're having an argument with somebody, you can explain to them what your teacher meant by giving you this slightly different definition from what you see in the textbooks. Okay. Now look at this. This is an option pricing calculator. Okay. So you see here, I don't know, can you guys see the size of the font? I mean the prices, 100, 35. Can you guys read all this?
Yes, sir.
Okay, good.
Yes, sir.
Yeah, good. So you can see here the price of a call option. This is the option pricing calculator. Now you see that it depends on many things. So you can see the reason that the definition is focusing on the underlying price, because the main, now this is basically, this is a model output call option, and this is derived mechanically. So this is a secondary model output. This is the main model output, theoretical price. And these are the model inputs. Okay. Now, as you can see here, there are many inputs. Okay. So when you look at the definition here, why am I, focusing on this definition like this? So you see, why is the definition? Value is derived from an underlying asset. Okay. So this term underlying, I've already explained to you with the help of the SPY option. Value is derived from an underlying asset. Now, the general definition that you hear, which does not include these qualifiers, if you see that, that means it's only saying that it is derived from the value of the underlying asset. But this is not true, because there are many other things which affect the value of the derivative product. Okay, in this case, the call option is a derivative product. Let me show you something. Days, I'm going to change this input. Okay, I'm going to make it, notice what happens to this 3.02. It's 30 days. I'm going to change it from 30 days to, let's say, 250 days. What happens? You see the change? 9.5. 3.02 to 9.5. 250 trading days is what we count for 1 year. Can you see this? Did I change the underlying? No. But I changed another factor, and it affects the value of the derivative product. Okay, let me change something else. Let me change interest rates. Now the price is, so let me go back to 30 here. Okay. And the price is back to 3.02. So we'll just call it 3 or 3.02. Okay. Now let me change interest rates. Okay. Let me raise the interest rates massively. Let's make it 45%. What happens? Changes the price of the derivative product. Okay. So there are many calculations we can do. Very important, eyeball. Very, very important input. Okay. Eyeball, or your estimate of the vol. Right now the figure is 25. Price is 4.93. Let me change this to, this can easily happen, 75. What happens? Goes to 8.75, 8.7. Okay. So can you see this? Now you see why I put this statement in. You will not find this wording in most of the definitions. In many textbooks, you'll find the definition of the derivative instrument is one whose value is derived from the value of an underlying asset. Now this statement is not true strictly, because there are many other factors also which which affect the value of a derivative instrument. So therefore the correct way to state it is that it is derived principally from the value of an underlying asset, which means there could be other factors also affecting the value of the derivative instrument. I hope everybody has understood this. So I'm spending a lot of time on very basic terminology, but it's very important to understand these terms, exactly why I'm saying what I'm saying. One word makes a difference. And it's also teaching you a way of thinking. Okay, it's more than just what I'm teaching you here. It's also teaching you a way of thinking as to how you should criticize people when they speak, when they are talking about technical matters, how you should attack their statements and their logic, and how you should interpret their statements. If somebody is giving a statement without any qualifier, that means that statement must be always true. And so if you know the statement is not always true, you can immediately attack that statement, right? So, so if you know that, you know, the project was worked on by everybody and somebody says this project was done by Sambhavna, immediately you can say, no, no, Gagan did the appendices. So you should say it is done primarily by Sambhavna. So that is how you correct people's language. Okay. So this is how you, so this is important. So options are derivative instruments, and every derivative instrument, so it has, so the definition of a derivative is something whose value is derived principally from the value of an underlying asset. And there are other factors also. Okay, let me put that here also. I'm going to create a new word here, instrument value. Okay, a value. Instrument value means the value of the instrument. Okay. But there are other factors also. So I'm making it very, very clear. Okay. There are other factors also that affect the instrument value. Okay, so this is what we understand now. Some two basic definitions we got out of the way. Derivative instruments, how they are contrasted. So we are learning a few things. Derivative instruments, what are derivative instruments? And they're contrasted with underlying markets and also sometimes called cash markets. So derivative markets versus underlying markets, or derivative markets versus cash markets. Okay, then what is the definition of a derivative instrument? Value is derived principally from the value of an underlying asset, but there are other factors also that affect the instrument value, okay, which you saw firsthand here. You can see it firsthand here. You can play around with it. You may not understand all the components at this point, but you can play around. You can clearly see that this, I've told you, this is the model output, and these are the model inputs. Okay, and you can calculate and see how it is changing. Right now, the other thing that we have to learn is the what are the possible, this is something else you have to have an understanding of. What are the possible underlying assets for options? When options are the derivative instrument, what are the possible underlying assets? There could be many. They can be spot. So we go back to this framework. Options are derivative markets, okay? But as we know, all derivative markets must have an underlying asset. So the underlying asset for a derivative product, especially when it's options, what could be those underlying assets? That's what we are asking at this point. Well, they could be anything. Usually you don't have them on cash because there's no time, actually, it has to settle immediately. But the underlying asset could be spot, it could be futures, it could be forwards, it could be swaps, okay? It could even be options. That's what it says here, okay? Spot, option. In this case, when the underlying asset is an option, it's a compound option. As I said, you can read about compound options in my book. You can find it in the finance reference. Compound options, it could be futures, which are called futures options. It could be forwards, okay? It could be swaps. In the case of swaps, these are called swap options or swaptions. These also you can read about swaptions in my book. You can read about those. We're probably not going to have time to cover swaptions. But at least you should understand what a swaption is. Somebody asks you in an interview, what is a swaption? A swaption is an option on a swap. Okay. Normally we talk about swaptions as, if you see here, at the intersection of debt and options. Normally swaptions are, there are other types of swaps, but normally when we talk about swaps, one of the most important categories is interest rate. I mean, basically interest rate swaps, swaps related to debt securities. So when you have a term like swaptions, that is the intersection of debt and options. So options are, swaptions are options on swaps, and swaps are actually related to debt securities. Okay, so this actually should be here. Okay, debt swaps. I put this in the wrong place actually. IRGs. No, it has to be here. There's a slight problem with the framework because options are, swaptions are options on debt security. If I put it here, they will fall under swaps. I can't put them here. Okay, so there are some limitations of this framework when you have more complicated structures. but this is basically what it is. So if somebody asks you what is a swaption, it's an option on a swap. It's basically an option. It's a derivative product, and the underlying for that derivative product is actually a swap. And then you have to go into what is a swap. That you have not learned yet. We will learn that in IFM in the next course. All right. So this is as far as this is concerned. And now we go into the next topic. So I've highlighted the topics here like this. So you make sure that you make your own notes. These are all topics. These are all markers for you. You can figure out, okay, these are the concepts I need to be clear about. What is a derivative instrument? What is an underlying asset? Okay. What is the definition of a derivative? Why did I change the definition to add the word principally? Okay, what are cash markets versus derivative markets? Underlying markets versus derivative markets? What is the difference in the use of the term cash? L&T wants to buy $20 million value cash. That is one use of the word term cash. But then I say that, if the derivative market, the option price is 1.7, and I ask, what is the cash market doing? That's a different use of the word term cash, of the term cash. Make sure you understand all these things, okay? Make your notes in your own language. Doesn't have to be perfect English, but you should understand the concept. Now, aspects of an option contract, okay, as you can see, these are the things that, okay, that when we want the option price is called the premium. So if somebody says, what is the option premium? What he's talking about is the option price, which is here. Okay, this is what he's talking about. Now, if you want a option premium to be quoted by the trader, if you're a price taker, if you're a customer or price taker, you want the what is MM? If we are talking about terminology like price taker, and I use a term like MM, what am I referring to? Anybody? You've forgotten? So who makes the prices? Different types of players in the market. You guys have all forgotten. Market maker. So if I'm referring to MM, I'm referring to market makers. Okay. So remember that because this is there already taught to you, and I've asked you guys to look at the notes yourself. These are basic theoretical concepts: price takers, price makers, market makers. So in order for the market maker to quote you a price or an option, you have to specify the following. This I've written as 0 because this is not really that you can tell him later, but this is not required. The price is quoted per unit. The price is quoted per stock actually. And so therefore this is not so important, number of contracts, but he will also require this information sometimes if you're trading in a very large amount. Okay. So you can take this as item number 0. This is not really important, but mainly you'll have to tell him the different aspects of an option. If you want him to quote you a price, you'll have to tell him whether this is a call or a put. Okay. Now, I hope everybody understands what is the difference between a call and a put. So a call, haven't you guys done this in your FM1, FM2? Yes. What happened? Everybody's gone quiet. Let's ask Abha. Have you guys done this in your FM1, FM2?
Yes, sir, we have done.
You've done it, right? So you've done calls and puts. You have done strike price.
Yes, sir.
Yeah, you've done all this stuff. Strike price, you know all this stuff. Maybe you've forgotten. Okay, but you've done some basic stuff. So just quickly going to repeat for you. Okay, just to make sure, refresh your memory, because clearly you have forgotten market makers as well. Okay, you have to tell the market maker whether you want the price for a call or a put, because as you can see, the two prices are different. Okay, this is call is 8.7, put is 8.4. Okay, so it's a different price. So you have to specify if it's a call or a put. You have to specify what is the underlying asset. Okay, which means you have to specify a market instrument combination. So it is not sufficient to say that the underlying asset is, say, dollar yen. That is not sufficient. You have to clarify whether it's dollar yen spot or dollar yen futures or dollar yen forwards, okay? Or dollar yen swap is difficult to have an option on the FX currency swap, on the FX swap. But you can have, so you have to specify these, any of these instruments. So not only do you have to specify, so when you say, when you define the underlying asset, okay, you have to specify it as a market instrument combination. So if you go back to the example of S&P, of the SPY, okay, if you want a price for the 200 put, if you want a price for the 200 put, okay, you have to specify many things. You have to specify that it's a put, and you have to also specify what is the underlying asset, and you have to specify, now this is the market, okay, SPY is the market. SPY is one of the assets, is one share in the Spiders Trust, and the other asset is US dollars because it's priced in US dollars. So this is the market, and it's trading on a value spot basis. So you have to know this. Most of the stocks that you traded in your first term, in your previous term, those are trading on a spot basis. Even today, this list of tickers, these are all spot equities. So these ETFs are trading on a spot basis, as in spot, not value cash, not futures, not forwards, not swaps, not options, but trading on spot basis, T+2 or T+3 usually. Okay, so this is what you have to understand. So when we say, not only do you have to specify that I am in, the underlying asset is SPY, you have to also specify that it is SPY spot. Okay, so that's why I say, this is what I mean by market instrument combination. You have to remember, these are instruments. These are instruments, and inside these you have all these markets. Okay, so inside currencies, spot, if you blow up this thing, you have to imagine that inside this are all the possible combinations of currency pairs you can think of. Dollar rupee, US dollar, Turkish lira, Japanese yen against South Korean won, Canadian dollars against Swiss francs. Everything, this is like the NC2, you remember your permutations and combinations from school. So this is like you have to do NC2, where N is the number of currencies, and that NC2 will give you the total number of markets that are contained inside this box. You have to imagine it, obviously, because the box is not big enough. So each of those is a market. Canadian dollars against Japanese yen is a market, and it is trading on a spot basis, and spot is the instrument. Okay, so you have to understand that is the market. So in this case, the market here is SPY, one share of SPY against US dollars. Okay, shares of SPY against US dollars. Those are the two assets, and it is trading on a spot basis. So you have to tell the market maker that it is, you have to tell the market maker that it is the SPY spot. Okay, so underlying asset, you have to specify not just the market, but also the instrument. So the market instrument combination has to be specified. That's what I mean by number 2, point number 2. Point number 3, expiration date, that is given here. If you're in Yahoo Finance, under the options tab, you saw what I did. There are many expiration dates for options. I could have chosen any of these. Now let's say I choose just after the option election is over, November 16th. I will get a different set of prices. Okay, it gives me a different set of prices. So by November 16th, we should have some clarity on who has won the election. This year, there's a lot of these unsolicited paper ballots that have been mailed out. So there's going to be time to count, because there's a risk this year that you will not know the results of the US election on election night or the next day. It will take a long time to figure out who won. And so if you take this expiration, if you're interested in an auction that expires on November 30th, that gives you enough time to figure out who has won. And that's basically, so that's one of the things that when you, because the prices are all different. Okay, so if you look at the value of the 200 put now, the 200 put, if you look at, now the value is quite different, okay? It's much less. You see, that was 1.7, the earlier one we looked at, that was 1.7, and this one is 200, is 0.05, so the value is different. So expiration date, when does this option expire? That is another thing that you have to specify. If you're playing around with this, expiration is given over here. You can change this. You can change it from 30 days to 90 days. And as you can see, it'll affect the price of the option. You can change, so it goes dramatically higher, okay? Because the eyeballs are very high already. So, so this is another thing that happens, that you have to tell the trader. You have to tell the market maker, if you want a price from him, you have to tell him what is the expiration date, okay? You have to also tell him the strike price. Okay, these are all things we have already done, but I'm just quickly going through them. Maybe we don't need to do this. Strike price, you guys are already familiar with this. You read up on it. Okay, strike price was covered in FM2. You guys know about strike price, right? Yes? Anybody?
No, sir.
Strike price was not covered. Okay, strike price. Okay, so calls and puts, you know, calls and puts, a call. We got this. So we'll. What we can do is we'll just stop it here because there's no reason. Let me. Okay, so please, what you do is, I'll just dismiss the class in a few minutes. So what you do is you make sure you start doing your readings, and also start doing the readings under this and start playing around so that we can move a little bit faster. Okay, these are the points that we have to cover. Okay, so please start doing your readings, and then we'll meet you guys tomorrow at 11:15. Okay, so the class is dismissed, and you read up on this, right? Okay, so do that, and then I'll see you guys tomorrow. So anybody has the rest of the class is dismissed. Anybody has a question can stay back. So Shaurya, your question, we will have, you first try out what I told you to do in the morning, in the earlier part of the class, that you try to log in at a more normal time, like the opening of the US market.
Like around 7 o'clock, 7:30.
Yeah. So when there's unlikely to be a system update, and see if it works at that time. If you still have a problem, then we can discuss it further.
Okay, sir. Sir, now I have a question regarding the current, just the current thing that you have told just right now, that is regarding the call put option. Call option basically means that that I will buy the option if it reaches a certain price, whereas put option means selling at a certain price.
No. What you can do is you can read the chapters that I've given you here from your textbook. Okay, you can read the chapters I've given you here. You can also read some of the other stuff that I've given you here. You can read some of these notes from here from the hyperlink.
Optioneducation.org. Okay.
Yeah, all those. Use the links that I've given you. Okay, if I've given you a link, that means it's safe. That means the knowledge is good quality knowledge. Okay. So I'll just explain to you briefly, Shaurya. The call option is an option to buy. Okay.
Yes,
and
sir.
put option is an option to sell.
Yes, sir.
And so it's a call option means it's if I'm talking about SPY, okay, SPY here, if I'm looking at the 200 put, that means it's the option to sell SPY at a price of 200. It's an option to sell SPY at a price of 200 when the underlying price right now is 340. The underlying asset price is 340. I want to have an option to sell it, okay, at the price of 200. That's the strike price. And the price for that option is, so the put option is the option to sell. The call option is the option to buy. Okay, so if I'm looking at a call option here, okay, say at the price of 363, okay, if it's a price of 363 and I want to take a call option, that price is around 93 cents right now. And so this is the option to buy. The call option is an option to buy the underlying asset at a price of 363. So if I exercise that option, okay, then I will end up buying it at a price of 363. Is this clear? So call option is, but do some reading from here, you'll get more clarity. Okay, do reading from the books that are given here as well as the textbook. Yes, go ahead.
Sir, like the call options in Indian market, sir, do they also have a time period of 1 week?
No, time period. See, in Indian markets, the reason I don't
Expiry, sir. Expiry.
Yeah, expiry date. No, I'm sorry. Let me understand your question better. Can you explain your question once again?
Like, sir, uh, if we investment in call option, then, sir, we have to buy, like, if a stock is at 200 now,
Yeah.
call option is for 250, 300 for the future. Like, the stock will go for at 250, and so there is a certain time period written over there, like 250 for the month of July, 250 for the month of August, like this.
Yeah, so there are options. I'm not able to actually, your voice is also cracking up a little bit. But basically, see that the point is, as you can see here, that if you change the expiration date. So this is the other point, that when you read this, that's why it's in the introductory part of the options. You have to specify the expiration date, because if you change the expiration date, the price will change. So every
So if we increase the date, like if we go further, the price will increase.
Correct. Okay, so you can practice it here. You can practice here also. Another thing you can do, Shaurya is also, and everybody else, play around with the software. Okay, see what happens. Okay, how it behaves. If you change this from 90 to 120, see what happens to the price. The price will go up. Okay.
Yes, sir. Sir, actually, sir, I have done some investment in options.
Okay.
So, yes, sir. So, but it's very risky, sir.
Yeah, well, it's not risky means, okay, risky is a subjective term. So everything can, I mean, everything, there is risk in everything. Anytime you do something in terms of
the lot size, like, sir, if we are buying an option, like a call option or a put option, there is a lot size.
Correct.
A point movement can, sir, make a lot of difference.
Correct. You have to watch the lot size also. Here, the lot size in the case of US equity options, the lot size is one contract. You can trade in one contract. One contract relates to an underlying shares, underlying 100 shares underlying. Okay, because the spot market lot size, the lot size of the spot market, which is the underlying market, is 100 shares, which you found out in your previous project. And so when you trade options, every option is one contract. You can buy one contract or sell one contract, but that one contract will relate to 100 shares, which means that when you look at the price, okay, so if they say here the price is say 43.40, okay, if the price is 43.40, this is the price per share. So when you look at the total price of the 300 call, you have to multiply this by 100. So if you buy one contract of the 300 call, you will have to pay, not including commissions, you'll have to pay 43.4 into 100. Okay, so 4,340.
Sir, one more question, sir, which I have observed. Like, sir, when the expiry date is coming near, the premium was reducing.
Correct. That happens. So that is called theta. Okay, we will be covering that. So you can, that is the reverse of what we just saw. If you increase the expiration date, the number of days, okay, the term of the tenor, we can just call this the tenor of the option. Okay, the tenor of the option, this tenor is longer than 90 days here. If you reduce the tenor, the price will drop. Okay, so as you saw, what you saw is what you saw is what is called the theta. We will see that later. That is one of the Greeks that Utsav was mentioning earlier in the previous session. Okay, so you guys can do these readings, and then we will continue in the next class. You will have a better idea as you do some of the readings that I've given you. Okay, and you can also read the note itself and try to play around with the software.
Yes, sir.
All right, and also revise whatever you did in FM1, FM2, and make sure you can revise. But you can, I think for the moment, you can just cover, because I'm starting from scratch anyway. So you can just revise what I've given you here. Make sure you just read the stuff. Okay.
Sir, sir, we have to do this option trading in stocks or basically for the index?
No, these are, see, the option trading is going to be done in these particular tickers. You will be trading options on these underlying assets.
Okay, sir.
Okay. So with reference to your question, some of these, you said indices or stocks. Well, the first answer to your question is that you are going to be trading in this particular project, you will be trading options on these tickers. Now, these tickers are of two types. One type is individual equities like
And sir,
the Microsoft, etc. And other type of ticker is ETFs. And our ETFs, many of them track particular indices like S&P 500, NASDAQ 100, Russell 2000. Okay. So the answer to your question is both,
okay.
right? So the main thing is to start with trading on individual underlying assets.
Sir, one more question, sir, which I haven't asked earlier. Like in equity ETF, sir, there is a percentage of each stock were given, like Apple 6%, and
Yeah.
sir, 10 stocks. Sir, that the movement of ETF depend on the weightage of these stocks.
Yeah. So weightage will affect the movement, obviously, right? So
Okay.
the price, the ETF is actually is trying to mimic the index, and the index has a certain composition. And the movement of the asset, the movement of the component stocks will affect the movement of the asset, movement of the ETF price,
Okay, sir.
right? Just like you see the total team score in a cricket match is consists of the total scores. Of course, there are extras also, but it generally consists of the scores of the individual batsmen.
Hmm.
So if every batsman has low scores, then the total team score will be low,
No.
right?
Okay, sir.
Okay. All right. Anything else?
No, sir.
All right. Okay. So if nobody else has any questions, then I'll stop the recording.